Risks of alternative investments. Alternative investments can offer high returns, but they also come with risks that many investors overlook. So before you chase yield, let's talk about the dangers you need to understand. So what are alternative investments? They include real estate, private equity, crypto, commodities, and more. They live outside the stock and bond markets. And while they can offer strong returns, they're also more complex, less liquid, and harder to value. Risk 1, illiquidity. Most alternative investments can't be sold quickly. You may be locked into the investment for 3, 5, and even 10 or more years. If you need cash in a hurry, you're out of luck. Always know the liquidity terms before you invest. Risk number 2, transparency and complexity. Private deals often lack the reporting standards of public markets. You may not get regular updates or clear financials. You need to trust the operator and understand the structure. If the deal's too complex to explain in one sentence, be cautious. Risk number 3, operator and sponsor risk. In real estate or private equity, your return depends on who's running the deal. You're betting on the jockey just as much as the horse. If they're underwriting poorly or mismanaging funds or they just disappear, you lose. Always vet the sponsor's track record, communication style, and fee structure. Risk number 4, valuation and exit risk. Many alternative investments aren't priced daily like stocks, so you may not know what they're truly worth until you try to sell. And exits can depend on interest rates, buyer demand, and market timing. Risk number 5, regulatory and tax risk. Some alternatives, like crypto or offshore funds, come with shifting legal frameworks. A single IRS rule could change or impact how your gains are taxed or if your structure remains valid. Always consult with a CPA or legal advisor before entering complex deals. Risk number 6, concentration risk. Many investors go all in on one big real estate deal or fund. If that one deal goes sideways, it can wipe out your portfolio. Diversification across strategies, sectors, and timelines is key. So the final thought here, alternative investments can be powerful, but they're not magic. Do your homework, know the risks, and never invest in something that you don't fully understand. Smart investors don't avoid risk, they manage it intentionally. Check out my video here about betting the jockey as well as the horse. This goes over the 6 key questions that I ask any investment fund manager or private equity manager who is managing the investment I'm considering investing in. If you want help building a safer portfolio, download my free guide, the Alternative Investment Risk Checklist. It walks you through how to evaluate deals, sponsors, and exit strategies before you wire a dollar.